Really glad you could be here. Today, we're talking about what you really need to know to effectively plan your pre IPO tax, or if you're even thinking about acquisition, we're just going to give you a lot of tax hacks along the way here. But if you're even thinking about acquiring another company, which is you should be, because right now, with a change in the economy happening, it's one of the best opportunities to do so, or you're considering going public. There's a lot of things you should know tax related wise, and that's exactly what we're going to be talking about today. So with us today is Aaron Rubin. Now, as an attorney, a CPA, and CFP, Aaron runs a wealth management practice that integrates tax, financial planning, and investing. Now, Aaron helps his clients minimize their tax liability and keep more of their equity compensation so they can support the people they love and the causes they care about most. Whether in Silicon Valley, Austin, or the Tech Triangle, he works with pre-IPO executives and early employees at late-stage tech companies. Now, in 2019, Aaron published his first book, Financial Adult Auditing. I love it. I cannot speak today, Aaron. It's completely my fault. As a guide to help young professionals navigate tax, investment, and estate planning. Aaron, thanks for joining us today.
Yeah, no, thanks for having me. And so it's financial adulting, just to get
I was like, I get read adulting. And, I don't know, adultery. I was like throwing all kinds of things. You're like, it's not that.
Financial adultery is that's a different show.
It's a whole other show, Ty. A whole other show.
Probably need a couple therapists on that for that one. But yeah, I wrote that book. It was a labor of love. It certainly wasn't a labor of profit. But I got to get some important messages out there. So I enjoyed writing the book and love what I do now, helping young tech professionals really make some great decisions around their stock compensation. And there's so much out there, and it's one of the things that the mantra in our firm is it's not about what you make, it's about what you keep. And someone's always holding their hand out, trying to get some more money from you. It's usually the government. And now you're located in Florida there, and so you don't have the state income tax, which is nice. Here in California, we get blitzed by our state income tax, and upwards of 13%. For your state income tax. In addition to that federal income tax, which depending on the kind of income you have, that could be 37. So you're looking at in excess of 50% on certain transactions. So you gotta be mindful, you gotta plan, and you gotta know what you're doing. So it's and again, I love what I do because I get to help people keep more of their cash. And the people I work with, they run charities, they're heavily involved with their communities, and I always like to say that they know better to do with their money than what the government knows what to do with their money. So again, that's my passion.
That's awesome. So what makes you initially want to write the book?
So it actually comes out of a story that I tell in the book. I was a young financial planner. I'd done 3 years in public accounting, and then I was trying to work my book of business. I think as probably many of your listeners do their when you start out, you're trying to talk to everybody and learn more and kind of hone your skills. And I was talking with a really great friend of mine, and a super sharp guy, and his wife also super smart. I had nothing but respect for both of them. We were sitting around lunch, and I'd probably been in the financial planning industry for a year or two. And he said, oh yeah, I got this great product. I said, really? Which is sort of alarm bell number one. Nobody ever says they have a great product, right? And that's the most bizarre thing to say. So, well, tell me about it. Oh, well, gosh, it's an insurance policy, but not only is it an insurance policy, but it's also a retirement savings vehicle. And I went, and I looked at him, I said, you should probably know this, but you bought an annuity, is what you did. Oh no, I didn't buy an annuity. I bought insurance with retirement, protection or retirement benefits, something like that. And I said, oh no, this guy who's, again, he is super sharp. I shouldn't say was, he is super sharp. And I thought, if he can be, I want to be careful. If he can be convinced to buy an annuity, which probably wasn't in his best interest, what about those people who aren't in the financial industry? And he worked for an accounting firm as well. So I'm thinking, geez, there's a lot of people out there that need a lot of help. and I have the experience and the knowledge that I can give it to them. And so that's what prompted me to write that book.
So what do you think when it comes to taxes here? What are the things that as entrepreneurs we most overlook?
I think, again, from my perspective, because I deal a lot with people who have either founder stock or they have stock options or restricted stock awards. A lot of people tend to overlook that tax part of things. So, I've worked with, people that had hundreds of millions worth of stock options. And, had they made a couple moves early on, they could have, avoided, tens of millions of dollars in tax. And so part of it is not getting help early. And that is, working with a tax professional who knows what they're doing. And unfortunately, for individual taxation, there's a lot of low quality out there. I think for businesses, I think there's some really great affordable options, but I think unfortunately there's been a race to the bottom on the individual side. And so there's not a lot of good advice to be had, unfortunately. And so you fall into some landmines, you don't make the right elections at the right time. And then all of a sudden you find yourself with a big tax bill.
When you talk about stock options, tax nuisances kind of related to stock options, give me some insight. What happens there? Why is it that they're paying more than they should? And what are some things that they should be doing to avoid that?
Yeah. Again, generally speaking, in our world, stock options are divided into three basic categories. There are more, but you're looking at, incentive stock options, ISOs, non-qualified stock options, NSOs, or some call them NQSOs, and restricted stock units, or RSUs. And so, the RSUs, there's actually not a whole lot you can do about those. They're basically, what happens is they're granted to you when they vest, they automatically get taxed. If you're at a pre-IPO company, oftentimes there's another event that has to happen, either an acquisition or an IPO, before you do get that taxation. There are some issues, to work out there, but the real problem comes in on the ISO and the NSO side. And the two options are very similar to one another. The idea is that you have the right to buy your stock at a particular price, and the company is worth a certain price. And at some point, hopefully the company's growing, there's a delta there. And you get this bargain on purchasing the stock. And the problem with that is that bargain is taxed somewhere on your return. And it can be taxed on your W-2, which is a non-qualified stock option, or it can be taxed on a what I'll call a super secret part of your tax return, called the alternative minimum tax. And that's where ISOs come in. And that delta we see on ISOs, it kind of triggers another part of your tax return that most people actually don't pay. And so they're not really aware of it. And so there are strategies to get around it. So if you're early at a company, you're granted, however many thousands, hundreds of thousands of shares at fraction of a dollar, maybe they're 4 cents, 5 cents a pop. A lot of times you can do what's called an early exercise, and you can say, well, okay, I know these are going to vest over a 4-year period of time, but I want to buy them ahead of time. So, and so you got to put up the cash. So, let's say you got to put up $10,000 to buy, 100,000 shares of this stock. And the day you buy them, let's say it's the day that they're granted, in which case, almost always the price at which you can buy it for is equal to the price of its fair market value, right? There's no inherent gain, right? There's no paper gain. And if you can do that, and you file what's called an 83B election, which is essentially you file it within 30 days of whenever you take this action. You file the 83B election. You tell the IRS, hey, I want you to tax me on the difference, on what I paid and what it's worth. Well, here's the good news. It's zero. So essentially you tell the IRS, tax me on zero. And the IRS says, sure, I'll tax you on zero, no problem. But as those shares vest, as the company it's valued at higher multiples, you don't pay the tax on the vesting. You because you've already paid the tax, you've paid the zero. And so you get to avoid a lot of that taxation that you might have otherwise had to pay by making a simple election up front. So again, that's sort of a long-winded way to say, yeah, there are things you can do proactively that will help you pay less tax in the future.
How proactively? Like if somebody's thinking about, and you specialize in specifically in, helping people in this area that are doing acquisitions, and then also people that are getting ready to do an IPO. So when is the point? Because, in either one of those, there's so many details you're trying to work through. So when is the point that somebody should reach out to an advisor and get this kind of advice, that process?
Yeah, I think that the tax advice needs to happen earlier. So, again, so in our firm, we have a wealth, platform, and we also have a tax firm in-house. So oftentimes people come to us early on. There's not a whole lot we can do with them on let's say the wealth or the financial planning side, but we'll send them over to our tax side, and maybe they just need a calculation. They just need some ideas, and we're pretty reasonable on our cost on the tax side. And so I'd say, get that help earlier. If you're starting a company, or if you're getting granted options at a company, early on, pay a decent firm, a few $100 and get some good advice, because it could save you a lot down the line. So again, sooner rather than later is the answer.
When is too late? I know there's like an IPO lockup period, or there's, I think, something referred to as lockup period. So is there a point where it's too late?
No, there's never a point where it's too late. There's always something you can do to help, soften whatever blow that might be. The only exception would be on an acquisition, which sort of happens somewhat out of the blue, and it's a very short transaction time, and you often don't have choices. But if you're looking at an IPO, certainly you have more runway. And if again, people at companies, right, the rumors swirl around well before the S1, which is the confidential filing for an IPO, and well before the road shows start. And so, if people are talking about it quite a bit, and you think it's happening, within a year or two, and again, typically that's, you've gotten your D or E round of funding for your company. It's not too late, right? It may be more expensive than it would have been, but still, if you can start the clock on some of your stock options before that IPO, you can get long-term capital gains sooner, which means you can get out of the position a little quicker. And there's some benefit to that, because as you mentioned, oftentimes there's a 6-month lockup period. Although there are some shifting sands there, because I've seen more and more companies, they'll let the employees sell like a certain percentage, let's say 25% of their vested options after the first earnings release post IPO, and then another 25% after the second earnings release, and then the 6 months they'll unlock the rest. So there are some more opportunities for liquidity than there were 5-6 years ago.
So what are some of the worst taxes that you see people pay that they shouldn't have to pay in those situations? They're getting ready to make an acquisition. They make an acquisition, they go they file for an IPO. They're an employee at an early stage company. Like, what's some of the worst things you've seen that have cost people like exorbitant amounts of money that they didn't have to have paid?
Yeah, I think there are a couple. One, they exercise a bunch of their ISO stock options. They create a huge AMT bill for themselves, and the thing about the AMT is that it affixes once you make that once you make the once you do the purchase. And if you and again, there are certain ways to try to get around that. So for a lot of the people that we work with, that if they can exercise in January, if they exercise in January, and IPOs are far from certain. Again, we like to think of them as, oh my gosh, the IPO happens and you make just tons of money, and that it happened. But over that first 12 months is a very volatile time. And so it could be that you buy your shares in January, your ISOs, and you have this huge tax burden for AMT, and you think, okay, well, I'm just gonna, as soon as let's say you bought it on January 2nd, you could say, okay, as soon as January 3rd of the next year hits, boom, I'm gonna sell it, and then I'm gonna cover my tax. Well, what happens if the price drops by 60%, which happens between when you bought it and December 31st of that year. The good news is that if you make that sale before that year is up, you can actually get rid of your AMT. You're going to have to pay regular income tax, but it's better than having to pay money on income you never received. So again, that's some of the things I see where people exercise late in the year. Their AMT bill gets fixed. If they exercise in November, December, their AMT bill gets fixed on December 31st. And then they have to come up with money on April 15th, by April 15. And it could be hundreds of thousands of dollars. And if they haven't planned for it, they can be in some trouble. And then the other thing I see a lot of is people have RSUs and they're double triggers. That means they pay the tax when the company has the acquisition or the IPO. And or sometimes it's 6 months after IPO. It's depending on what the company decides to do. And oftentimes there's a lot of under withholding because RSUs are usually considered a bonus and they're taxed at different rates than your normal wages. So people are severely under withheld. And then when the April 15th rolls around, they're like, wait a second, I did the withholding on this. Why do I have to pay more? And it's like, well, they didn't withhold enough. And so it's one of those things where, again, you got to work with that tax preparer to make sure that you've gone through all those calculations, because the company won't tell you that. Yeah. And it sucks to be hit with a huge penalty, when you really didn't do anything wrong.
What are some of the crucial like financial planning steps that somebody should take if they're thinking about acquiring a business, or they're before they even get too far into the IPO planning process?
I think, if you're on the acquisition side, I'm assuming you have some decent lawyers on your team. There's a one of the I'll say the greatest / worst stories that I've ever read had to do with Skype. I don't know if you or your listeners are familiar with it, but essentially, right before the acquisition of Microsoft and Skype, Skype canceled or recalled like almost all of their employee stock options, and they really screwed over everyone on the team. So if you're on the acquiring side, hopefully your attorneys are looking for that sort of stuff to maybe that might reduce your transaction costs. But again, I'm not for screwing people over, but if you're on the acquisition side, I'm sure you're doing your due diligence. If you're on the if you're on the buying side, if you're on the seller side, if you're doing that acquisition, chances are you don't really have a ton of time to purchase that stock, because chances are the acquirer wants to get the deal going, and they don't want to wait a year for your stock options to vest. It's just, so again, that's part of the hard part about that. Now, of course, if it's a part cash, part stock swap, you can, sometimes they'll swap out vested options of new co for your old co. And so at that point, if you may be part of it now of a publicly traded company. And if that's the case, maybe making that, maybe thinking about an acquisition strategy for those options make a lot of sense.
So when you do what you do, what are some of the moves that people have made on the opposite end that were really smart moves that you've helped people make that just saved them a ton of money?
So I'd say, when a lot of times, when you're in a non-publicly traded company, there's a tender offer of some sort, right? So an investor comes in and they want to buy stock from, the employees. And so, a lot of people that think, they look at it and say, well, geez, I want to buy a house, or I want to, there's lots of things I want to do. I have all this equity tied up. It'd be great to release some of it, to improve, quality of life. And so they'll go ahead and they'll make those trades. They'll create a big tax bill, but there are opportunities buried within that as well. So again, we talk about the incentive stock options. The way the AMT works, the higher your regular income tax, the more palatable your AMT differentials are. So, for instance, we had a client who sold $4 million it was a partial sale of some of their shares, and we turned around and said, well, geez, if you're going to raise your taxable income up to the point where if you go ahead and you exercise, 20,000 shares of your incentive stock options, you won't actually owe AMT at all. So again, there are things you can do that could wash out some of the liability you might otherwise have to pay. So again, that's a great example. So again, those RSUs, when they vest, if you have a spike in income and you're still sitting on unvested ISOs, you got to use that spike in income to your advantage.
You also talked a little bit about getting credit to buy stock options. So give me a little bit of insight. How does that work?
Yeah. So, as you know, in the credit market, there's people willing to lend money on everything. And now, of course, it comes at a price. Nothing's free. And the riskier the underlying investment, the more you're going to pay. And so oftentimes, however, we have employees at companies who are leaving for whatever reason. Sometimes they're getting a new gig. Sometimes, things didn't work out, whatever it is. And if you have incentive stock options, by law, you have 90 days to exercise those options, or they go away, or sometimes the company will convert them to non-qualified stock options. But you really want the incentive stock options because there's a big tax advantage there. And so, we work with a variety of lenders out there, and I could list them for you, that will lend people the money to buy those stock options. Because again, it could, and usually it's not the cost of the option that gets people, it's the tax. So these lenders will lend the money for the tax and for the underlying purchase itself. And so, but they charge an interest rate, and the interest rate's not that bad. The interest rate's only like, I haven't seen it in a couple months, and as you know, interest rates are up. But when I was looking, there are somewhere between 4% and 6%, simple interest, which you think is not that bad, but where they get you is they usually take some percentage of the shares as additional compensation. So they'll take that. So you'll get the 6% simple interest, and you'll have to pay in 10% of your shares, maybe even more, depending on how long it is to the liquidity event. And so, but if you're trying to get that long-term capital gain treatment without having to sell shares and you don't have the cash for it, that's the way you do it. And so there's lots of different ways, and there's new stuff coming out all the time. We've worked with, some of the bigger providers. So Quid is a big provider, as is ESO, Liquid Stock. There's lots of different, there's, probably 4 or 5, bigger ones out there. And they all sort of do different things, but then there's also people who I've seen people do call options. They write calls on pre-IPO stock, which I think is like the most insane thing I've ever heard of in my life. But they do. And there's a guy that I work with who's awesome, who I'd recommend anyone to talk to, who his job, his like full-time gig, is to help people maximize their opportunity there. So he will shop around to different providers, secondary markets, prepaid variable forward contracts, and traditional loans, and he will find you the best deal. That's his business model. I mean, that's how complicated that world has become. But again, it's a tremendous opportunity.
What other opportunities do you think out there that business owners miss because they don't have proper financial planning? Because I see a lot of that. The business owners, even without acquisition, without an IPO, just normal entrepreneurs that are in some stage before those. What are some opportunities you think they miss because they just don't have proper representation on the financial planning side?
Yeah, I think I was talking to a securities attorney about this just the other day, and our consensus was there's no reason for a pre-IPO company, however big or small, not to have the ability to early exercise. And I think a lot of times either I think, it's just sort of no one thinks about it, or no one really cares about it, and no one's thought it through. The attorneys don't want to deal with it. It's sort of another little wrinkle, but it's such a powerful thing to do. again, it's one of those things that I think a company really should have a look at that. The other thing that I see that a lot of companies don't do is they don't allow what's called a 10b5-1 plan for many employees. A 10b5-1 plan is what's called a non-discretionary plan. And when you're public, a lot of times people end up with being blacked out because they have insider information. And so what the 10b5-1 plan says is it says, hey, while I'm not blacked out, I want you to sell this stock when I am blacked out, if it reaches a certain price. And so that's why it's non-discretionary. And a lot of places don't allow for that, which again, I think it'd be so helpful to the employees and the owners, if they had a more robust system of selling stock. So again, that requires a little forethought. It requires some planning. And a lot of people just don't do it.
So somebody's getting ready to file, or somebody's ready to file for an IPO. Somebody's ready to go make an acquisition. As we get ready to wrap up, any advice we haven't talked about today that these guys or gals should know?
Yeah, I would say, I would get someone in the office to talk to your people about that, right? Because, I talk with a lot of employees, at pre-IPO companies, and their message to me is, I didn't know any of this, and there's a real lack of education there. Part of it is because, the people who are going to make the real money off of that deal, from the employees, they're financial advisors. They're not tax people, and they don't want to talk about tax because they're not as certain, and they don't want to take on the liability. And so, I was talking with someone, an employee at Robinhood, actually a little bit about this. And she said she was an admin. Now, she was an early admin. So she had, she didn't have like hundreds of thousands of shares, but she had tens of thousands of shares. And she said, basically they brought in some tax people for the engineers, and everyone else was sort of left to fend for themselves. And that's like, I look at that and I just think, you're not helping anyone. The employees, one, they want the information. Two, I think a lot of employees that, they're waiting for an event to happen to leave. And the question is, can you provide them with something extra that makes them stay? And so I'd say, if your company's looking to go, IPO, you have to be worried about a brain drain, to be quite honest, because a lot of people are like, hey, as soon as this thing vests, or as soon as, this thing goes IPO, I'm out. So again, I'd say careful about that, and, see if you can come up with a plan that'll help you kind of keep more of your talent in place.
Aaron, loved having you on the show today. Everybody watching and listening, where should they go to be able to learn more?
Website's great. WRPwealth.com. You can also check us out, Twitter, WRP Advisory, as well as Facebook. We're everywhere.
Awesome. Thanks for coming on.
All right. Thanks so much.
So listen, if you're watching or listening to this today, we just really scratched the surface. I mean, the reality is, no matter where you are in your entrepreneurial journey, you're paying more taxes than you should be. And the reality is, a large part of that is financial planning. A large part of that is knowing these ins and outs. So if you want to learn more, make sure you go to WRPwealth.com. WRPwealth.com, ton of resources here, including a blog that gives you all kinds of information. This is really, really relative to you, especially if you're even thinking about filing for an IPO. If you're thinking about making an acquisition, you need to know this stuff before you even start down that path. Because if not, it could cost you, literally, no exaggeration, millions, if not tens of millions of dollars in the process. And I got to tell you, I've been on the other side of that. I've got a lot of friends that have went down that road, didn't make these kind of calls, and then as a result, lost a ton of money. So don't let that be you. All you have to do is go to WRPwealth.com. That's WRPwealth.com. Tap into a lot of the resources, schedule a call with Aaron and his team, and it should save you a lot of money, help save you a lot of money on taxes as well. So make sure you visit WRPwealth.com. Thank you very much for